What are model portfolios? What do they look like? And is there a right answer? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. We often get questions about model portfolios and the allocation of bonds, stocks, and alternatives within a portfolio. But it seems there is a bit of confusion about the term model portfolio. So let's talk a bit about that today. When financial advisors speak about model portfolios, they're often referring to pre-built portfolios created by investment companies such as BlackRock, State Street, Goldman Sachs, or Merrill Lynch, and designed for a specific objective such as capital growth, capital preservation, and or tax optimization. These model portfolios, as the industry defines them, are essentially marketed as a product to financial advisors, who in turn offer them to their clients as an alternative to either an individually managed portfolio or a standardized investment product, such as a mutual fund or ETF. They're a bit of a combination or compromise. These types of model portfolios in the industry usually have minimum investment requirements starting from $10,000 or higher, plus ongoing management costs as well. These relatively high minimum investment requirements come from the fact that building, monitoring, and regularly rebalancing a portfolio does require quite a bit of work. And if you want a financial advisor to help you find the specific asset mix and concrete investment products that might be right for you personally, it will usually be even more expensive. As we always say, everyone's financial journey is different. But even if you're a well-informed, self-directed investor and decide that you want to build a personalized bond portfolio on your own, using the knowledge from our VIP investment club, our bond courses, and our YouTube channel as a starting point, even then, it may be sometimes useful to see what others are doing, which makes perfect sense, by the way. And if you're interested in deepening your knowledge, there's no better time to join our bond courses and VIP investment club than now, during our February sale for President's Day. Use coupon code INCOME2026 to take $100 off of our popular bond course bundle before midnight Eastern Time on Sunday, March 1st. Our popular bond course bundle includes both our foundational level bond beginners course as well as our intermediate level bond masters course. And for 2026, we've upgraded our courses to lifetime access. I've included the links below this video for your convenience if you want more details. And if you already understand some of the basics of bond investing, I'd like to invite you to become a part of our VIP investment club, where our members have daily conversations with me, Marcus, and one another on the best rates and investment opportunities they're interested in right now. We knew that our VIP investment club would be a special place for sharing member thoughts on money, investing, and retirement. But I'll be very honest, the amount of engagement and interaction that takes place in our VIP investment club every day never ceases to amaze me. In any case, we hope you will come join the discussion with us and our VIP members soon. The $100 coupon code INCOME2026 can be used for our bond courses and to join our VIP investment club as well. Quarterly if you want to test it out, semi-annually if you want to stay flexible, or annually if you're like most of our VIP members and want the best value. For now though, let's get back to model portfolios. So, if you're looking for a bit of competitive intelligence, so to say, on how others are building their portfolios, we think that 3 types of sources might be particularly helpful. So, with that in mind, here are the 3 topics I'll be covering today. 1. What are all-weather or one-size-fits-all portfolios? 2. How do target date funds differ from all-weather or one-size-fits-all portfolios? And 3. Which robo-advisors can give you some additional competitive intelligence on model portfolios? Let's dive in now, folks. What are all-weather or one-size-fits-all portfolios? All-weather or one-size-fits-all portfolios, as their names imply, are really meant to be kept the same throughout their life. There are many of these portfolios out there, but let's look at 3 that are associated with well-known investors and specifically intended to condense their personal experience and wisdom into a manageable formula for individual investors. We'll start with the most growth-oriented one. Warren Buffett's 90-10 portfolio may be the most simple of them all and reflects his strong belief that large-cap U.S. equities will produce the strongest growth in the long run. In his own words, "My advice could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. I believe the long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers." Next comes David Swensen, whose name has come up a few times already in our courses and on our channel. For 36 years, from 1985 right up to his death in 2021, he was the chief investment officer of the Yale Endowment and achieved spectacular returns by diversifying its assets into alternative assets such as private equity, hedge funds, and more. To the surprise of some observers, his Guide to Sleeping Soundly portfolio that he proposed back in 2009 in the Yale Alumni magazine does not contain any alternative investments in the narrower sense. So Swensen balances his Sleeping Soundly portfolio more evenly than Buffett and allocates only 50% of assets to stocks, although with a strong international diversification. He proposes 30% domestic stock funds, 15% developed markets, and even 5% emerging markets. The more income-focused other 50% of the portfolio would go to 20% into REITs, real estate investment trusts, and closer to what we often discuss in our Diamond NestEgg community, 30% into U.S. government bonds, equally split between 15% normal U.S. treasuries and 15% inflation-protected tips. And last but not least, at the conservative or defensive end of the spectrum, we find permanent portfolios that promise to protect wealth through all economic and business cycles. In its most basic form, such a permanent portfolio would allocate 25% each to the U.S. stock market, long-term U.S. Treasury bonds, short-term U.S. Treasury bills, and gold. This concept of a simple permanent portfolio for individual investors was first popularized by Harry Browne in his 1981 book, Inflation Proofing Your Investments, that he co-authored with Terry Coxon. Harry Browne, by the way, was an American investment advisor, writer, and 2 times presidential candidate for the Libertarian Party, who died in 2006. So, now that you have an understanding of how one-size-fits-all or all-weather portfolios work, let's move on to the next topic of today's discussion. How do target date funds differ from all-weather or one-size-fits-all portfolios? Target date funds go a step beyond all-weather and one-size-fits-all portfolios. These funds are not really customized by risk appetite or any other truly personal circumstances, but they do adjust their portfolios over time from a growth orientation to capital protection and income as their specific target date approaches. You can find them frequently in employer-sponsored 401k plans as one of the options to customize your portfolio towards a certain retirement date. Vanguard, Fidelity, T. Rowe Price, BlackRock, and Capital Group, for example, all offer target date funds, usually with maturities spaced apart in 5-year intervals. And if we take Vanguard as an illustration, and we want to see what the portfolio composition looks like for someone planning to retire around 2040, we would select their Target Retirement 2040 Fund, or VFORX, and click on Portfolio Composition. And voila! Here we can see what its current portfolio looks like at the time of this taping. It's really only 4 widely diversified index funds for the total U.S. stock market: international stocks, domestic bonds, and international bonds. And it shows about 75% in equities and 25% in fixed income, percentages that are roughly in line with what our best model portfolios and bond masters would propose for someone in their 50s, although with a little twist towards more equities and less fixed income. And if we look up the portfolio composition for the Vanguard Target Retirement 2025 fund, which would be intended for someone who is already in retirement, Basically, we can see that as expected, the portfolio is shifted more heavily towards fixed income, which now makes up 50% of the portfolio. It now even includes an 8% slice of a TIPS fund, Vanguard's short-term inflation-protected securities index fund. Now that we've covered target date funds, let's keep going with the next topic for today. Which robo-advisors can give you some additional competitive intelligence on model portfolios? So, all the leading brokerage firms, including Fidelity, Vanguard, Schwab, and E-Trade, as well as some smaller, newer ones like Betterment and Wealthfront, offer robo-advisors these days. These robo-advisors are standardized models that work with a defined set of products, mostly low-cost index funds and ETFs, often from the offering firm. But they can be customized to a certain degree to the specific risk profiles, investment goals, and time horizons, as well as some other preferences of the investor. Now, many of these robo-advisors are accessible on the internet, at least in a basic version. If we take Fidelity as our example this time, they even offer 3 different robo-advisors on their public website under the Fidelity Go brand, one specifically for retirement planning, one for healthcare, and one for other goals. There's something else option here. For the purposes of this video, let's choose retirement. In the next step, I'll answer a few basic questions where I'll indicate that I'm a moderately conservative investor planning to retire in about 2040. I'm not, assuming all goes as planned, but let's just play this out. Here, I get to a proposed high-level asset allocation proposal, as you can see from this screenshot. If you compare this to Vanguard's target date fund allocation from before, you can see that it recommends slightly more fixed income, 40% bonds to 60% equities, which is actually even more bond heavy than our own best model portfolio proposals in Bond Masters for a moderately conservative investor in their early 50s. To get more details and product information, Fidelity wants me to open an account on the next page, which is not really surprising. However, that would probably go too far for the purposes of this video, and so let's leave it at that. That said, Charles Schwab offers a free version of their robo-advisor, Schwab Intelligent Portfolio, on their website as well. And if I give essentially the same input to answer their questions, I get a somewhat different proposed asset allocation here, one that's weighted with 65% towards stocks. So more in line with the 2040 Vanguard Target Date Retirement Fund allocation, and a bit more aggressive than the Fidelity proposal. I should note, though, that Schwab did structure their questionnaire a bit differently from Fidelity, especially when they wanted to know about my risk appetite. So that might have influenced the different results as well. So you see, it might make sense to play around with these various pieces of information that are available. But in the end, there's no single right answer here, and there never is in financial markets. So take these as what they are, additional information or data points. In the end, you still need to decide what's right for you and your personal circumstances, goals, and expectations. So, now that we've cleared up what model portfolios in the financial services industry are, and where else you may want to look for some competitive intelligence, if you're ready to really give your fixed income journey a good boost and fine-tune your own portfolio, I invite you to use coupon code INCOME2026 to take $100 off of our popular Bond Course Bundle and VIP Investment Club membership before midnight Eastern Time on Sunday, March 1st. Our bond courses are the first step in learning all about fundamental treasury, agency, corporate, and municipal bond concepts and how to build a bond portfolio. And our VIP Investment Club allows you to advance beyond that and dive deeper. Remember, our Diamond NestEgg VIP Investment Club is the ideal place for you if you want to 1. Have an extra pair of eyes for critical investing questions. 2. Get ready for the retirement decisions that lie ahead for yourself or a loved one. 3. Understand how a product works, its benefits, and its risks. 4. Be the first to know about safe and or higher yielding investments. 5. Spot and clearly understand new market trends and issues. 6. Exchange perspectives with a like-minded community. And or 7. Continue your lifelong learning about investing and retirement. If you fall into one, some, or all of these categories, Visit our website after this video at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button or this Bond Course Bundle button to learn more. I've also linked everything below this video for you. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.